Now, later today, around midday, the Bank of England's Monetary Policy Committee will announce its latest interest rate decision. And there has been speculation now, well, it's really, really widespread, started at the weekend in most of the papers, by the way, they could change the rate. And it's been at an historic low for nearly 3.5 years. The suggestion is it will go down from 0.5% to 0.25%. Now, if you're buying a house, you can cheer and holler and hoot. If you're living off your savings, you probably put your head in your hands and weep. So which way should they go? Kevin Mountford is head of banking at moneysupermarket.com, joins me now. You see the argument for going down to 0.25%, Kevin?
Well, I think, Nick, clearly the economy's in need of a boost. We've had some good news of late, I guess. Inflation's fallen dramatically over recent months, but this on its own isn't going to be enough to ignite spending and, as such, kickstart the economy. So, as you rightly say, focus turns to the Monetary Policy Committee today. And generally it has two choices. One's around quantitative easing. We've had lots of that today, which may or may not work, depending on your views. The other option's around base rate. The problem being at 0.5%, there isn't much that it can do in terms of going further, as it gets us closer to 0% interest. And no doubt a base rate cut could provide further stimulus in the economy. For some people, though, it could also represent the last roll of the dice. So it's a difficult one, and I think that's why, to date, it's been resisted. But I think, now we're getting desperate measures, and if not today, we're very close to a possible decision to bring it down even further.
Stay on the line, Kevin. Back to you in a second. Listening to that is Simon Rose, who's spoken with Save Our Savers. Simon, desperate measures for desperate times, so cut the interest rate?
Absolutely not. Look, it's been, as you say, for getting on for 4 years. It's been 0.5%. It hasn't boosted the economy, nor has QE. Yes, they're desperate because they're doing entirely the wrong things. What they've failed to understand, because they haven't really ever looked at the real world, ever studied their textbooks in university, is that if you could grow an economy by cutting interest rates, every single economy in the world would have done it and we'd all be incredibly wealthy. There should be a free market. Why do we have this Stalinist-style, Soviet-style control of the price of money from the Bank of England? Because if we're going to grow the economy, what we need is capital that is going to enable businesses to grow. Where does the capital come from? It comes from savings. So instead of encouraging savings, they are discouraging it. We are mired in debt, and the lower they cut interest rates, the more inclined people are to get into debt, and we'll never get out of this massive hole we're in.
Let's put that to Kevin Mountford, back to Kevin, head of banking at MoneySupermarket.com. That's an interesting one from Simon Rose. If, of course, it was all driven by interest rates, as Simon says, well, every country in the world will be controlling it in this fashion.
It would, but I think we also need to recognise the fact that the current situation or the current structure has survived us for over 300 years. I think the important thing is that it does fail to stimulate savings, and we all recognise we need medium, long-term savings because we hear that the pension market's blown, etc. We've got to look after our own devices. The one thing I would say is that, there are far more savers than borrowers in the UK. I think 0.25% reduction is reported to deliver something like £600 million of benefit for those people who are fortunate enough to be on trackers. That's fine for those people, as long as they don't continue to pay off debt and they actually spend some of that. But the main thing is around savers. The only thing I would say is that if you look at the savings market in the UK, the banks, relatively speaking, are offering what I think are inflated rates anyway, because they're desperate to get hold of our cash. The average savings rate in the UK is less than bank base rate, so it's less than 0.5%. For those people who can be prepared to be a bit more active, you can get 5 or 6 times more than that. So I think we also need to start waking up to the fact we've got a high degree of apathy. We all have it in our own control to do far better than we currently are.
Kevin Mountford, head of banking at MoneySupermarket.com. Thank you for that. Back to Simon Rose. Quick word on that. Taking on board all the points you make, but in a way, are some of the savers fools to themselves and they're not getting out there, they're not getting up and down the high street?
Savers certainly need to be more active. It's foolish to get an incredibly low rate, as Kevin said. As Kevin also said, though, the system's worked for 300 years, and for most of 300 years, interest rates have actually been above inflation. Now they're below. That's why it isn't working. And if we're being totally honest, I'm afraid this is crony capitalism. And the reason that rates are low and they're coming out with QE is to fund their friends in the banks and to keep the bust banks afloat. We're being bled dry so bankers can keep paying bonuses. It's utterly outrageous.
Thanks for that. Simon Rose is with Save Our Savers. Your calls 22.9 is the time.